Hello everyone, Assalamu alaikum. Now today's session is about the revision aspect, another revision aspect of the investment appraisal topic, and particularly the topic about capital asset pricing model. The calculation of weighted average cost of capital by CAPM. That is what the basic purpose of this particular session. Now candidates, first of all, a very quick aspect, whatever we have done till last. Candidates, we have done actually our first topic of the AFM, that's about the advanced investment appraisal. And for the sake of the advanced investment appraisal, we need to review the investment appraisal topic. And for investment appraisal topic, first we reviewed a basic question that's about the NPV and review the nitty-gritties about the cash flow aspects, NPV structure aspects, all these things that we have already done. After that, we started with respect to the previous matter, that's the revision of WACC. And we know very well that WACC means investors required return. And investors required return calculated by valuation method, that's we have already done. And another, the capital asset pricing model or capital asset pricing method. So the purpose of today's session is to how to calculate the WACC by CAPM. So let's start the topic. A very important question, a very important question about that. If investor required return, which we say WACC, the already we have the topic that is the valuation method. So why we need another method, that is capital asset pricing model? Why? What the reason for the capital asset pricing model? What the reason of this capital asset pricing model? What's the reason? The reason is very clear. For example, if you are an investor, listen this statement to me. If you are an investor and there is a meeting right now and I am the relevant person who will get your money and wanted to invest in a particular project, so definitely I will show the expected future cash flows related to that particular project. The expected future cash flows of the particular project. I will definitely show you. What I will present you. I will present the matter like this. Investor, Mr. Investor, I will provide you. You invest some money now. For example, $1 million. I will give you the return, the future cash flows over the time period. For example, over 1 to 5 years. And these cash flow, future cash flows are the net cash flows or the inflows, the returns. If you are investor, if you are investor, and if you ask me that, you are showing the picture to me, means I'm showing the picture to you as an investor. Show I am the manager of the company or the manager of the project. I'm showing the picture to you, the investor, about this future cash flows, and then also the discount rate to calculate the NPV. And let's suppose the NPV is positive. And you the investor ask me that how you calculate this discount rate. For example, this is 10%. You would ask me how you calculate this 10% for the investor required return. And I reply that by this valuation method. For example, by KE dividend valuation model. Let's specific to KE. KE valuation model, dividend valuation model. So you, the investor, will reply me that you incorporate, sorry, you calculate our return, that is by dividend valuation model. But can you reply that the future inflows, these future inflows that you are projecting to us over the year 1 to 5, is this the confirmed cash flow or the variations? Try to understand this statement, candidates. What you ask to me as an investor, that you ask to me that whatever the projection it shows, year 1, 2, 3, 4, 5, is that the confirmed projections or there are chances of variation? At that question, I I replied with a smiley face that, Mr. Investor, you are an equity holder. And with respect to equity in the real world, there is always a risk. You are very innocent. You are very innocent to ask this question. But actually, as an equity holder, nothing the returns are guaranteed. There may be chances of the variation. There is a risk. And after that, you replied, oh, it means that future cash flow having risk. But the return you calculated by valuation model not incorporated any level of risk. Candidates, what I say to you, a very simple thing. The limitation of dividend valuation model to calculate the KE is that with respect to dividend valuation model, we calculate the return but without the consideration of the risk. Without the consideration of the risk. Without the consideration of the risk. And for that particular reason, we work on the capital asset pricing model. Capital asset pricing model is a model from where we calculate the return, equity holder required return, or even the debt holder required return with the consideration of the risk. With the consideration of the risk. So let's start the working that how we calculate the return, how we calculate the return with the consideration of risk. The very basic formula that you know that RF plus RM minus RF multiplied by beta equity. So with this method, we can calculate the KE. It's a very basic F9. RF represent the risk-free rate of return, risk-free rate of return. Like government T-bills, RM means market average return, and RM minus RF, that is the difference between the risk-free rate and the market return, that is risk premium, and beta equity is the risk adjustment factor, and that risk adjustment factor having two components. What are the two specific risk factors with respect to beta equity? That is systematic risk and financial risk. Systematic risk and the financial risk. Never mention that beta equity includes systematic and unsystematic. Always systematic risk and the financial risk. That's a key point to consider. Now, the very important thing you have to consider here, that how beta asset drives, sorry, how beta equity drives, how the risk incorporate in CAPM, how the risk incorporate with CAPM formula. How risk or incorporates with CAPM. This is the very important topic you have to cover and you must have to know. How risk incorporate with CAPM. Candidates, this is a very critical discussion. Now we are going to discuss. We are going to end with this. Let's suppose what CAPM says. What CAPM says that how risk incorporate with respect to investor required return. Basically, how risk incorporate with the WACC or the required return. Number one, you must have to aware one thing, that let's suppose you are an equity holder. You are an equity holder and you are expecting a return from a company. Return. What return you are expecting? You are expecting that company will generate the sales and incurring some operating cost. So generate some PBIT. That's operating profit. That's PBIT. Huh? That's PBIT. And after that, the company will pay the interest, tax, and then handing over money to me. That's profit after tax. And that's equals to shareholder. That belongs to shareholder. Any investor, any equity investor always expect this return. Always expects this return. But there's always the risk that whatever the profit is thinking, that may have some variation. That may have some variation. And that variation called risk. There's a risk that whatever the profit we are expecting, we cannot generate. But what are the reasons and what particular risk any equity holder bear on his or her shoulder as an equity holder, bear the risk on the shoulders? What are the particular risk? Now let's suppose that you are an equity holder. You are an equity holder and you have the amount of $1 million. You have the amount of $1 million. And me, you are an investor, me, a company, Toyota. Me, a particular company, Toyota. And you as an equity holder wants to get return from me as a Toyota to get this particular return. But you are expecting some risk that whatever the return I'm expecting, that's having this risk that I might not be able to give you the return up to the mark. There's a risk. So you wanted to evaluate that what are the factors which includes this risk? What are the aspects to consider this risk? Do remember you have $1 million and you wanted to invest the money somewhere. And I am Toyota. You are also considering me to invest in the industry of car industry and a particular company, Toyota. But you, Mr. Investor, having $1 million, you have taken an advice. You have taken an advice from an investor or from a finance manager or financial consultant that I have $1 million and I'm going to invest the whole money in Toyota, the car industry. So apparently, what financial advisor advise or respond? No, 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 no. Don't invest all the money in one particular basket. Instead, you have to spread the money. Means diversified. Spread the amount to somewhere. You have to spread your money. And definitely, this is a very reasonable aspect. Some money I have to invest um, for, let's suppose, telecom TC, for textile, for bank, for airline, and for car industry as well. Spreading the money. Don't put all the eggs in one basket. Spreading the money. Because any specific risk, if you wanted to avoid, you can avoid it. For example, if all the money invests with respect to the car industry, what financial advisor says that nowadays there are too many competition in the car, and in fact there are very much concerns about the car industry related to, for example, power, fuel aspects related to the car and directly hit it to the car industry, a number of factors. So with respect to car industry, to avoid the risk, specific risk, you can switch to the airline. Airline have different risk. So out of 1 million, you have spared a certain amount for car industry. For example, let's suppose out of 1 million, you have 200,000 for the car industry. For airline, avoid the risk of the car and switch to airline, not uh, invested the complete amount, but switch to airline. 300,000 to airline, avoiding some specific risk to the airline, shift to bank, 50,000 to bank, avoiding bank something to textile, some amount to the textile, avoiding textile risk to the telecom. So what you are doing, you are actually spreading the risk. You are actually diversifying the risk. You are actually avoiding the risk, whatever the risk you can avoid. So first the CAPM says that if you wanted to calculate the return, if you wanted to calculate the return, or investor needs to calculate the return, first of all, identify the risk that you can avoid. So by making a portfolio means number of investment. That's car, airline, bank, textile, telecom. Your total risk are going to reduce, but the risk cannot be totally reduced. The risk, by this diversification, whatever the risk you can avoid, that's called unsystematic risk. Whatever the specific risk you can avoid by diversifying the business, that's called unsystematic risk. But some of the risk still maintain that cannot be avoided, that's the systematic risk. The risk that cannot be avoided, all the macro factors which is outside the country, outside the control of the company, like macroeconomic factors like inflation, like fiscal policy. Inflation means monetary policy. Like political situation, like now the world issue, like the coronavirus. That's nobody can avoid it. That is the systematic risk. Systematic risk hit to every industry, somewhere higher, somewhere lower, but hit it to all the industry. For example, in a particular economy, if the inflation increases, that inflation affected to all the industry, more effective to luxury, less effective to the necessities or comfort, but hit it to the whole industry. Do remember, one thing is economy, the complete market. For example, American market, for example, Dubai market, for example, Pakistan market, a complete stock exchange is a market. The stock exchange includes 100 industry, car industry, telecom industry, textile industry, banking industry. That's individual industry. And each industry has a specific companies. So what I'm saying to you that systematic risks are the macro factors in a particular economy hit it to all industries. For example, inflation in Pakistan hit it to all industry, car industry, banking industry, food industry, but hit it to the all industries, with some industries affected lower, some industries affected higher. Same case, coronavirus. Coronavirus affecting more to the electronics, but less to the food, more to the car, more to the fuel, but less to the foods, as compared to car industry, less effect to the telecom, and in fact, very least effect to the bandwidth and internet aspects of the business, because social distancing, after that more involvement with the internet, media industry affecting lower one because everyone watching the media. So different industry has different dynamics. I hope that all of you with me. Furthermore, what I say to you that CAPM, first of all, consider that whenever you calculate the return, you must have to consider first what the risk an investor can avoid. That is the specific risk that can be avoided. That can be avoidable. Avoidable risk, specific risk, unsystematic risk are interchangeable words. Whatever the remaining risk, that's called systematic risk. That's called systematic risk. So our question remains same, still exists. What, why shareholder are worried that in future this profit after tax not can may not be available? That's a variation. There are three aspects that need to consider. Number one, first thing, the systematic risk hit to the operating profit. For example, inflation higher and sales drops. Inflation higher, material cost higher, labor cost higher. That's operating profit dropped. So first risk that an equity holder equity holder consider that my profit may vary due to the reason of systematic risk. And this systematic risk can be measured. This systematic risk can be measured through a terminology called beta asset. How to calculate, we will discuss later. That's a beta asset. Number two, the another important thing, when systematic risk hit to the operating profit of the company, another important thing that what is the proportion of operating fixed cost and operating variable cost. This proportion of fixed and variable called business risk. And business risk means nature of the business. If systematic risk hit to the sales of the company, for example, inflation higher, and at that particular company having higher fixed cost, so systematic risk hit it, higher business risk, higher fixed cost means higher business risk, very sharply operating profit decline. So one thing is systematic risk. Another thing is the business risk. Business risk is depend on nature of business. What type of business you are doing, with the which you are getting the combination of fixed and variable cost. High tech industries having higher business risk because the setup cost of the fixed cost is higher. Airline companies 50% fixed, 50% variable. Food cost, In the airline industry, variable. Fuel cost, variable. In the education industry, most majority of the cost belongs to the teaching, and most of the cases teaching are the variables. So education industry, business risk, where teachers costs are variable, most of the variable, that's lower risk. And third, the very important risk, that's the financial risk. That's the financial risk. That's a financial risk. That's very much important. Systematic risk measured with beta asset. Operating risk, sorry, business risk measured with operating gearing. That's the ratio of fixed cost over variable cost. And the last one, that's the interest. Interest is measured with financial risk, debt over equity. Debt over equity. That's the important thing. Now, candidates, very much important, need to consider here the very much important further point need to consider here, that's financial risk, all the aspects. You have to cover one very important aspect here with respect to CAPM. CAPM says that the only risk we will consider, that is the systematic risk. The only risk we will consider, that's the systematic risk. Sorry. CAPM says that first of all, take up the portfolio theory. And portfolio theory includes systematic risk and consider both risk, systematic, unsystematic. But on the other hand, the CAPM only welcomes the systematic risk. Only welcome the systematic risk. Portfolio theory considers systematic and unsystematic. CAPM only consider the systematic risk. Only consider the systematic risk. And after that, when we calculate the KE, so we have to consider that systematic risk is measured through beta asset. And the working of beta asset in this scenario, beta asset into beta equity into E upon E plus D 1 minus T. And this beta asset represents the systematic risk. This is financial gearing adjustment, and beta equity includes the combination of both part, systematic risk and the financial risk. Beta equity includes both elements, systematic risk and financial gearing adjustment. Now, the final conclusive point with respect to this figure. You are investor, listen carefully, focus here. If you are investor and you have decided that you will invest 200 out of 1 million, 200,000 with Toyota. So how Toyota will calculate the return for the investor by CAPM? Toyota will reply in this manner. Toyota will reply in this manner. Mr. Investor, number one, listen this carefully. Number one by one. Mr. Investor, you are most welcome to invest 200,000 amount in our company, Toyota. Now, we wanted to clarify some important point to you. What important point? Number one, the first important point. You are a well diversified investor, but where you invested your remaining amount, we don't have any concern. This statement is very much important. The CAPM says that investor is well diversified. It's assumption of the CAPM, which means that whenever you calculate the return, means whenever Toyota calculate the return, Toyota has no concern that where the investor already diversified. It means Toyota has no concern to incorporate the risk element of unsystematic in the returns. That's why in betas for the risk calculations, for the return calculation, we don't consider unsystematic risk. We ignore the unsystematic risk. We ignore the unsystematic risk. Once again, CAPM assumes that investor well diversified. For example, Toyota says that investor, Mr. Investor, I don't have any concern that where you have invested the amount anywhere. I will not give any, I have no concern. Number one. Number two, the Toyota says to the investor, Mr. Investor, you are welcome to car industry, where car industry having different companies like Hyundai, like Honda, like Mercedes, other companies. In a particular industry, there are different companies, but in a particular industry, the systematic risk in a same manner to all the companies of the particular industry. For example, if the government announced some fiscal policy, taxation matter, tax increases, so then it will impact to the whole car industry, affecting same to Honda, Toyota, and other companies, Suzuki, all the companies, in a same manner. So, Mr. Investor, if you come with Toyota, I will give you the return against the systematic risk in the same manner as the Honda, as the Hyundai, as the Mercedes, as other industry, as other companies in the industry. This is the first point. So systematic risk. So the systematic risk affecting different industries in different manner. But for a particular industry, affecting same manner to all the companies. If another example, inflation hit it to the industries, different to the food industry, different to the car industry, different to the banking industry, different to the telecom industry. All industries affecting different in manner the monetary policy. But if affect to the telecom, so if there are four companies in the telecom, so the monetary policy affecting to the telecom affecting same manner all the companies within the industry. That is the point. So Toyota replied that I will provide the return. I will not provide the return about the unsystematic risk because we assume that you are well diversified. Number two, I will provide the return about the systematic risk, but that is equal to all companies in the car industry. And number three, Toyota says that my financial risk is unique, is specific to any other company. My financial risk is unique, it's specific to any other company, which means that in a particular industry, I am Toyota, another one's Honda, another one Suzuki, another one Hyundai, Kia, Mercedes, all specific car companies having different financial risk. So as a Toyota, we will provide you the return. We will provide you the return with the risk of systematic risk of car industry and my particular financial gearing adjustment. Both one. My particular financial gear adjustment. Both one. And finally, how to calculate the return by CAPM? First of all, we calculate the return in this manner. KE is equal to, first, we start the return with risk free. Mr. Investor, we will provide you the return plus risk free because you are investing in the market and the market return must be more than risk free. But how much more than? I, Toyota, is a part of market, so my risk may be, that's beta equity, it's equal to market, greater than market, or less than market. So it depends that whatever my total risk what? Beta equity, systematic risk, and financial risk. Whatever my risk in totality, more than market, I will give you return more than market. Equal to market, I will risk equal to market, I will give you the equal to the market return. Less than the risk of the market, I will give into the return less than the market. Candidates, for your information, which you haven't studied in FM, by CAPM, you can calculate KD as well. And KD calculate RF plus RM minus RF multiplied by beta debts. So do remember that by CAPM, you can calculate by KE as well as KD, both. And CAPM is a superior method for your information. Is a superior method. If debt beta is given, you have to calculate the KD by debt beta, not the valuation. Furthermore, moreover, this is the complete formula of beta. This is what the complete formula of beta. In F9, there was always assumption that dead beta 0. So that's why this portion eliminates. In AFM, majority of the times, beta that's not available. Majority of the times. But if available, that means this is the complete formula. Otherwise, we will work out only this one. You must have to know that the term beta acid is called ungeared beta. That means no financial risk. The beta without financial risk. And beta equity means geared beta. That is the point. Now let's take an example. Let's start the example. So finally we can say that a very specific point must be in our mind. NPV means in we are here to analyze the investment analysis by NPV. And NPV means future cash flow and discount rate. One thing very clear in our mind, if we are evaluating the investment by NPV. So actually, whatever the risk with respect to this future cash flow, we calculate the future cash flow, na? But this will not happen exactly. There is a risk. Whatever the risk in the future cash flow, that risk must be embedded with this discount rate. That risk must be embedded with this discount rate. That's all, nothing else. So discount rate must incorporate the risk that's actually with respect to the future cash flow. That is what the only point. And for this point, the most supportive working we can get, that's the CAPM. Now, we have to consider that whatever the investment analysis we are making, either that investment analysis about the same business where we say that expansion. If about the same business, so we can use the same WAC. Yes, use the same WAC, same KE. Yes, same beta asset. For example, you are a bank and you have a plan to, you have 100 branches. You wanted to expand the bank with 20 branches, but you need money and you are going to analyze the investment. What if 20 branches add on? That's expansion. So about the analysis of 20 branches add on investment appraisal, you can use the same WAC, same KE, same beta asset, because there is no change in the systematic risk. No change in systematic risk. But what if you are a bank and you are analyzing the investment with a different business? and that's called diversification. For example, bank wants to move telecom. Banks wants to move telecom. We cannot use same WAC. We cannot use same WAC. We cannot use same KE. We cannot use same beta asset. Because why? Because change in systematic risk. Change in systematic risk. But do remember one thing. There you have studied F9 till that point with an assumption. And right till now, the assumption is still maintained. And what's the assumption? Either the investment as an expansion or as diversification. Means no change in systematic risk or change in systematic risk. But in any of the case, no change in financial risk. There, that's an assumption since FM, and we are still maintaining this assumption until the next topic starts, that APV. What does that mean? Simple means. For example, you are a bank and you wanted to invest more in the banking sector, expansion with the 20 branches. So you will arrange the finance. You will arrange the finance in a manner that your financial risk will not change. For example, previously the ratio debt over equity 50-50. So you will arrange the new finance in same proportion 50-50. So financial risk not change. Or you will um, invest for expansion with internal source of finance. No change in financial risk. Even though if you are a bank, move towards telecom diversification. This is an investment. You are going to change your systematic risk, but you are arranging the finance in a same manner that debt ratio not change. Or you have available internal source of finance, same. But that's the assumption still maintained until unless we are not going to start the topic APV. That's the most important thing you have to consider. Huh? Candidates, before starting any question about it, one more thing you have to consider, that one more thing you need to consider here. In case of specifically diversification, for the working of beta, for the working of KE, that's the 3 steps solution. First of all, you required beta asset of diversified industry, DI diversified industry. That's called beta equity E upon E plus D 1 minus T. That's the first step. You will take the proxy For example, you are a bank, move to the telecom. You wanted to move to the telecom. So first of all, you want the telecom's beta asset. If telecom beta asset not given, you will enter in any particular company of the telecom, ABC company. That's called proxy. And get the financial risk of the proxy. That is financial risk of proxy to identify beta asset. And this step is called, you wanted to identify ungeared beta. Second step, once you identify the ungeared beta, then you need to know about geared beta. Geared beta means beta acid adjust with financial risk of company. With the same above formula. Beta acid of diversified industry, and then adjust with financial risk of the company. And third step, the KE, with respect to diversification. Now, based on this, we have to work out a question based on this.